Good afternoon, everyone. I'm Stacy Scott, and I'm here with Graham Wickham, President and CEO of Wickham Financial and Insurance Services. And we're back with you today with our weekly wrap-up. Graham, it's been a little bit of time since we've been on a weekly wrap-up. What can you tell us about what's been going on in the market?
It has. Thank you, Stacey, and thanks for our listeners being on the call. I just enjoyed a great vacation with my family, so it's time to get back to business, right?
Right.
We saw the U.S. equities edge a bit lower last week after the labor market showed some signals, maybe small signals of some cooling, but it still maybe solidified that the Fed's got more work to do with interest rate hikes. I don't know if that's any information that we didn't already expect, but that's what probably spooked the market. And plus, we had a pretty big advance in the first half and maybe a little profit taking. But going by the numbers, we look at the Russell 2000 fell about 1.25%. We saw the NASDAQ, the S&P slide about 1%. So we did see 10 of the 11 S&P sectors in the negative area. Looked at healthcare and basic materials dropped about 2.3%. But on the other side, in a positive way, we saw crude oil prices rise about 4.5%. Looking at jobs report, that came in below estimates for the first time in 15 months, but it did show enough underlying strength that it still boosted Treasury yields, really soared a lot last week on the Treasuries. We saw wage growth higher at 0.4% month over month, 4.4% year over year, and that was a bit above forecast. If we look at the ADP private payroll report, I mean, that's really where we saw the surge. That was up a whopping 497,000, almost 500,000 new jobs. So we're looking at job openings did fall in May, but quits did rise. So if we go back and look at the FMFC, the Federal Reserve minutes from their last meeting, we did see a fair number of members really suggesting some rate hikes instead of the pause that we experienced at that time.
Okay, well, what are your thoughts on how things are going internationally?
Yeah, I think, we had Janet Yellen, Secretary Yellen, going over to China, trying to foster a more balanced approach to our relationship with some market reforms, maybe some fair trade practices being kind of the front of the conversation. But we're still seeing China really struggle with a factory and service activity slowing in June, really struggling trying to get the economy back in a more positive growth phase. If we go to the Eurozone, we're looking at the PMI numbers, and Germany's production figures still suggested a weak recovery from the recent technical recession. So inflation is still high in some areas, struggling to really grow in some others overseas.
All right. Well, do we have any indicators on what the second half of the year might look like in the S&P?
Well, there's no crystal ball to this, but we did have the Carson Group kind of put out a little statement, and they said about 23 years since 1950, where the S&P has produced a first half return of at least 10%. All right, and I'm including this year. We saw some positive returns in the second half. So if we break that down a little bit further, and if we're just looking at 22 instances, not this year, 18 of those were positive. That's 82%. In the second half, when the second half of the year followed a 10% or greater increase, we had the average return in that second half of about 7.7%.
All right. Well, what are your thoughts on what groups might lead the rally?
Well, I'd like to believe that we'll have a broadening out. I think the leaders still might be there and viable. Maybe they have a little bit of pullback that leaves some room for the underperformers, maybe that more value trade, maybe deep consumer discretionary, maybe some, we look at, some of the healthcare area that underperformed a lot this year compared to 22, maybe start to make up some room. Really the laggards, maybe the deep values start bouncing back a little bit. Some of those high growth AI kind of pull back. Keep in mind that 7 to 10 stocks made up of 85% of the S&P's return this year. So you really had to be very concentrated and very focused to get all the return of the S&P. Now, the Dow lagged a good bit, and the NASDAQ really shot forward because it's my majority of it is tech and growth.
All right. Well, thank you so much for that, Graham. And thank you to
Yeah.
our viewers for joining us today. And, I know we're still in the dog days of summer, but as we look toward August and going back to school, we do have our classes for retirement planning today scheduled for August. So just check back with us. And if you or someone you know who is at or near retirement age, we would love to see you in class in August. So just keep a eye out for the details that are forthcoming. And thanks again for joining us today. We'll look forward to seeing you again next week on the weekly wrap up. Have a great week.
Take care.